battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name's Nick Stenger. We are Stenger Family Office. For the past 44 long years, it's been our family's mission to deliver both clarity and confidence to help secure your financial future. The AI Bubble 199. If you're counting along, you know the next episode is 200. And what happens at episode 200? We are live at Francesca's next week. And this is your last chance if you want to get on the waiting list. It's linked in YouTube there. You can still register. It's going to be packed. We're going to have standing room only for the last 3 or 4 people probably that register. But if you get on it quick enough, you may be able to get a seat. So make sure you sign up if you still want to come to Investor Day as well. We've got space. Producer O, if you don't mind throwing that up. Next, we've got Investor Day right around the corner, and we are about 80% full, and we are still a few months out. So make sure if you're going to come to Investor Day, register. I have people every single week telling me, Nick, I'm coming. I just haven't registered yet. This thing is going to fill up very quickly. The next email we send out will probably be the last, and that's why you also need to subscribe to the show, share it with your friends and family. When you subscribe, you get alerts for these events right when they come out so you can get on the list. So make sure you subscribe on YouTube, Apple, and Spotify. We so appreciate it if you can do that. Episode 199, the AI bubble. Yes, I do think pockets of AI are a bubble, and it's not just me. We're going to talk about somebody in a second who is very prominent in the AI business. He also thinks we're in pockets of a bubble as well. But in my estimation, there's really 3 parts of AI out there, and not every single part is in a bubble. There's certain companies that I would call the real pipes and wires companies. That's number 1. These companies are not in a bubble. Some of them are going to have some earnings changes. They're going to lose some gross margin. The businesses are going to evolve just like any other tech company on earth. But when you look at the pipes and wires economy of AI, I think a lot of these companies are real businesses, and you should buy them. You should have them in your portfolio. Number 2 is what I would call the pioneers. They're not necessarily in a bubble, but it's highly uncertain what the future looks like for them. And this is true of anything. If you went back to 1999, you equal weighted every single publicly traded tech company in 1999. Well, 20 years later now, 25 years later, you would have exactly a 0% return because half the companies went up and did really well, and half of them went down and went to 0. And so instead, what it took, and not a lot of people could do this, is the fortitude to understand which companies are going to win. We don't get into that game at Stenger Family Office in client portfolios. We never want to try and say out of 50 tech companies, here are the winners and the losers. That is not our specialty. Our job is to wait until they're real companies and they move into that first bucket as pipes and wires companies, and then make sure we get them in your portfolio at that point. But we never want to go out and pay 600-700 times earnings for a company if we don't have to. We'd rather just wait till they have real business models. Yes, I know it sounds crazy to want to see some cash flow and some profitability before you buy a company for a client, but that is the Stenger method. We do wait till companies are profitable. So that is part of our approach. And then number 3 is just these almost borderline, I'm not going to name any names, so sorry to disappoint, but there are companies that I would call bandwagon bubble companies that are almost borderline like fraudulent, and they are just a couple of guys in their mom's basement, and they started a company and put .ai at the end of it just to try and raise some capital from whoever bites in Silicon Valley. And those are a disaster. Like I would just be very, very cautious of those. But that is typical of every bubble, every market cycle. Don't be alarmed by this. Don't be surprised by it. It exists in every single place on earth. And I'm going to tell you in a second, we're going to look into the crystal ball. Yes, some of you have asked, Nick, where is the crystal ball? And what are your crystal ball predictions? I'm going to give you my crystal ball predictions here for AI. Now, let's talk about number 1 here, pipes and wires economy of AI. You've got Nvidia at the very top. Nvidia is a real company. So I did have somebody who said to me the other day, Nick, aren't you worried about Nvidia? And okay, maybe. What am I supposed to be worried about, though? That their valuation's too high? Okay, you can make a case there. Am I supposed to be worried that AI is overblown? Maybe. I don't know. But Sam Altman at OpenAI just came out and said they're spending billions and billions of dollars still. So I just don't know what the case would be to short Nvidia. I'm not saying put your entire portfolio in it, but Nvidia is about as pipes and wires of this economy as you can get. Now, all this to say, none of this show is stock advice. This is all just for fun, just entertainment. Don't do anything I'm about to tell you. But Nvidia has $176 billion of annual revenue on a go-forward basis. That's a lot of revenue. That's a lot of money. This is not pets.com of the 90s that we'll look at in a second that was just being valued off of eyeballs, people looking at their website with no revenue, no earnings. Nvidia is a real company. They also do $87 billion. This is the projection on a go-forward basis in pre-tax income. That's their profit before they pay taxes. That's a lot of money. That's more than the GDP of a lot of countries. And they're currently sitting on a war chest of cash, $54 billion with a B. You heard that right, $54 billion in cash. So you look at a company like Nvidia trading at 58 forward times earnings. It's projected to decrease to 40, and you can't debate the fact this is a real company. But some people are going to say, is 40 on a go-forward basis after their earnings go up? Maybe they do $4 in earnings, and the stock's in the 170s. Maybe the stock trades 40 times earnings, 45. Is that too much to pay for Nvidia? I just don't think so. I think if you look at their growth rate, if you look at the structural case here, I just don't see a world where you trade that thing for 10, maybe, 30, 35. This is the problem with these companies. And it's a problem with another company that we're going to look at here, Microsoft. This is another pipes and wires company trading at 34 times forward earnings. And you're thinking to yourself, Nick, is that too much to pay for Microsoft? How is it possible that Microsoft's over 500 a share now and very, very close to that $4 trillion in market cap amount? Well, look at their numbers here. It's all supported by the data. $306 billion in annual revenue at Microsoft, $136 billion. This isn't pre-tax profit, but this is annual operating income. They're sitting on another war chest of cash, $94 billion. And I'm just looking at these companies. I'm looking at the free cash flow. These are real businesses. You just can't get around it. And so, again, another company where you could argue maybe the P is a little too high, but what do you replace it with? Who's going to come out and beat Microsoft at their own game? It's almost impossible. I'm not going to say it's impossible, but it's almost impossible. Another one here. Now, this isn't quite as pipes and wires as the other two companies we just looked at, but I just want you to see some of the numbers here behind Meta, and this is what a lot of people didn't understand. Now, we first bought Meta for clients at 150, then it went to 90. Some of you were like, Nick, you're out of your mind. What were you thinking? Why did you buy it at 150? And we said, no, hang on a second. Meta, back in 2022, was trading for 12 times forward earnings. It was a value stock. And we said, buy it. And we did. We bought it again for clients in the 90s. Some people got it at 90, some at 100. Well, that stock's over 700 today, just 3 years later. Look at the numbers behind Meta here. 3.48 billion with a B, daily active people. That's their biggest metric. They have literally half the world as their customer. Name any other business on earth that has half the world as their customer. Not even Apple. Apple has a lot of competition. They're losing market share with certain Samsung phones and the rest of it. Meta has 3.48 billion active daily people. For an average revenue of about $54 per user, that number is set to go up. They're projected to do $190 billion in annual revenue. They have $47 billion in cash, and they're trading at 26 times forward earnings. I still think the case can be made that Meta is not overly pricey. It's not overvalued. Again, none of this is stock advice. Not telling you to do anything, not telling you to sell or buy or anything like that. Just pointing out the fact, informational purposes only, that these companies are tremendous, tremendous businesses. Those are not in a bubble. Now, let's talk about number two. These are the pioneers of AI. Could you call them a bubble? Yes, you could in some cases, but I don't think they mean to be bubbly companies. They're not just faking it, right? They're not just the two guys in their basement .ai. These are real companies with real revenues. However, with one caveat, they are trading very, very pricey. Number one is CoreWeave there, going to do $5 billion in annual revenue. That is projected by S&P. They just put it on an article. They think that's going to go to 15 or 16 billion. But right now, they're going to trade at about 9 times price to sales. That's 9 times revenue. And you look at that, you say 9 times revenue is a lot. That's more than a bank. That's more than a healthcare company. It's not like a value company that would trade 1.5 or 2 times revenue. But a tech company at 9 times earning isn't all that overvalued. I'm, again, not telling you to go buy it, but I'm just saying these are real companies. $5 billion in revenue is not a small amount of money. Let's talk about Palantir. Palantir we've been very cautious with, but Palantir generates $4 billion of revenue, 93 times price to sales. So for every dollar of revenue that Palantir has now, you're paying 93, not times earnings, times sales, compared to 9 for CoreWeave. And the PE on a go forward is 292. That's not the highest P of any stock out there. It's certainly not the highest of any AI company, but it's not cheap. Palantir is pricey. It's priced for perfection. So when you see the downturns, I'm not saying it's a bad company, not saying they're not going to make it, but when you see the downturns, you could see a 20-30% pullback on Palantir like that, as opposed to some of the more value-oriented names. Snowflake, $4 billion in annual revenue, 16x price to sales, not the most pricey, but heavily pricey. OpenAI, not a publicly traded company, but just raised another round of funding. They're projected to do $20 billion in annual revenue. It's probably the best case of being an actual real story long term. But again, valued at $500 billion, trading for 25 times price to sales. That's a lot of money. So again, are these bubbly companies? Yes and no. Not because they wanted to be bubbly companies, just because the market has given them crazy valuations. And not to say they're not going to make it, but they could see 50, 60, 70% drawdowns in the short term. So just be careful. If you're going to buy some of these, be careful what your exposure is in the portfolio, similar to Amazon in the 90s. Amazon went down 97% in the 90s. How many people held it after that? Not too many. But again, are you going to go out and be able to pick all the winners and and know who the losers are and avoid them? It's hard to do that. So that's why we've avoided that. We wait till these companies become actual businesses with profitability. All right, let's talk about number 3. These are the bandwagon bubble companies. And this is where Sam Altman came out on August 18th, and he said that he sees a bubble forming as industry spending surges in AI. And he's the closest to it, him and Elon Musk. Now, Elon Musk has also said there could be a bubble in certain cases, but I take this pretty seriously because what I see is there's a lot of people who are just trying to ride the wave here. Be careful if you're doing private deals, if you're going out and you're investing in small, unheard of AI companies. I think a lot of those are just, frankly, a scam. And so this is the bubble that is happening, and this is what Altman is seeing as well. Now, here's another story that came out from MIT. This is also August 18th. MIT says 95% of generative AI pilots at companies, these are in-house models, like a model at Goldman Sachs or a model, I don't know about these companies specifically using AI, but just giving you an example, it's just a non-AI company using AI, 95% of those pilots are failing. So what does that tell you? It's either implementation's not working, maybe it's not as good of a story as people think. Some people say that could lead into and trickle into Nvidia. I think it's more so just to say we're just at the early innings of this thing. You have no idea what's coming. AI is real, but a lot of the use cases are as basic as just machine learning. Machine learning's been around forever. The cloud's been around for a long time now. What I keep saying is there's a lot of use cases that are even more basic than what you think of with AI that aren't really AI. They're machine learning. They're just artificial intelligence in some capacity, but not really this high tech approach. And that's where I think the real value add is for most of the Fortune 500 is just using the basics that are already out there. One of the examples here, and we talked about it on the show, is Zoom. Zoom is sending me an AI summary every single meeting I have, and then it's creating automated tasks based off the conversation, and then that gets synced to Salesforce, and I get a reminder of what I have to follow up on. That used to take an hour of my time after every meeting. So what does that do for productivity at Stenger Family Office? What does it do for productivity and earnings and Fortune 500 income statements? It sends earnings up. Absolutely reduces the need for more work than's necessary, and you can do more with less. It reduces the amount of resources you have to have, and when you reduce resources, you improve profitability. And so that's why I say be careful before you panic out of any of these companies in a downturn. Think about the use cases of AI and machine learning and cloud computing and all these real value adds of technology in reducing operating expenses for major Fortune 500. And that's what I think you're really going to see. So the biggest and best use case outside of all of this is the companies that are leveraging the technology. That's always been the story to improve margins. And that's why you're seeing S&P profits at record all-time highs. I've talked to you about this on the show. We're seeing about 340 as the long-range estimate for 2027, which is where the market's going to trade by the end of next year, which is how you have to buy the market. You can't buy it for next week. You can't buy it for next month. You have to buy it for 12, 18 months at least. And that sends the S&P up to 7,500 points. So again, I don't know the exact day. I look in the crystal ball. I say, crystal ball, can you please tell us when are we going to hit 7,500? If we could do that, we'd all do that, right? We just get our crystal ball. But that doesn't work. You don't look into the crystal ball and know exactly the date and time that the market hits 7,500. But that is the trajectory of where we are headed, which is why I say just stay on your plan. Don't panic. Don't get off the plan. Now, just to mention a couple other bubbly names here that have happened in the past, here's a chart from GameStop. And this was part of the meme stock craze a couple years ago during COVID. You saw GameStop go from $1.26, basically bankrupt, $1.26 a share, to $81 at the peak, back down to $22. So again, if you bought it at $1.26 and you rode it through the highs and now another back to a lower point at 22, you made a ton of money. You turned $1 basically into $22. That's a huge return. But if you bought it at 80 and now you're sitting at 22, not so good. So that's why I say just be careful. You don't want to get left holding the bag on any of these names because bubbles do form. And at the end of the day, fundamentals do matter. If you overpay for the best company on earth, you could pay the price 20, 30 years down the road. And that's what happened to people with Cisco in the 90s. They still have not recovered all of the money that they put into Cisco in 1997, 8, and 9. So just be careful what you're buying. Here's Plug Power, another chart. This was during the EV craze, not to say that EVs aren't real or important or anything like that, but the craze got away from us. If you bought it at 13, you went up to 66 in the short term, huge return, and now you're trading Plug Power at $1.58 a share. So be careful before you hold the bag on these names. You've got Pets.com. This was in the 90s. My favorite story went from $11 a share basically to zero. So that can happen too. Some of these companies will go to zero. Here's one last one for you before we get into a couple other ideas. But the tulip bubble in the 1600s, this is a real thing. People thought tulips were going to basically cure all their problems. It was really, they were finding these rare tulip bulbs, and people were trading tulips for like literally the cost of a house. So imagine if a house cost $400,000 today, you would have paid $400,000 for a single tulip bulb in the 1600s. That's kind of crazy, okay? So, for anybody who doubts that these bubbles can form, this does happen. Again, it's not every company in AI, but there's companies like this that exist today. Here's a question mark, and I'm not making a statement here. Is Bitcoin in a bubble? Question mark. I'm not saying it's in a bubble, but it could be. Is Bitcoin like the tulip mania of the 1600s? Does anybody really understand how this is all going to play out? Anybody who doesn't know, anybody who tells you they know exactly what Bitcoin is and does and how it's all going to work is lying. So I think be careful with all this stuff. I'm not saying don't buy Bitcoin. I'm not saying to think of it as a complete bubble, but maybe you should understand something before you buy it. That's my philosophy. And here we are, Bitcoin 113,000. Maybe it is real. I understand the reasoning behind it. I understand the logic. I understand blockchain. And by the way, I sympathize with all the people who like Bitcoin. They want to get away from centralized finance. They like DeFi, decentralized finance. They want to get away from centralized banking, which I love all that. I think that's great. I don't think we should have a Federal Reserve, quite frankly, in a lot of cases. But is the government going to allow this to continue forever? We'll see. So you go out and buy Bitcoin at 113, just be prepared for some big-time volatility. And that's why I say diversify. If you're going to own something like this, maybe you put 1 or 2% of the portfolio in. Just be careful before you over-leverage yourself into something that you don't understand. 3 other notable bubbles, and we'll let you go here. The Japanese real estate bubble, prices went up 3x and then fell right back down. The U.S. housing bubble in 08 and 09, prices doubled and came right back down. And then the tech bubble in 1999. And the reason I point these out is because what actually happened in reality was there was a long amount of time of great returns leading up to these bubbles. That's how the bubble forms. And so in 1999, for example, it wasn't like all of a sudden one day we had great returns and the next day we had terrible returns. It was a slow melt up. So 1992 is a phenomenal year, 93, 94, 95, 96, 97, 98. All of those years leading up to the tech crisis were just blowout, melt your face off years. And actually, you could have paid like 13, 14 times earnings for the S&P back then. And we told our clients, buy. But with the one caveat being be diversified. Because if this thing pops and then you get to 1999 and 2000 and you're paying 44 times earnings for the S&P, that's extremely, extremely frothy. And so, again, we could see something happen like this today. We're nowhere close to that, my opinion right now, but you could see a melt up. You could see us go from where we're at right now, about 21, 22 times forward earnings, maybe to 23, to 24, to 25. And if we start trading the S&P in the 30, 35, 40 times multiple, that is very, very rich. And I will get on the show. You know, I'm not a doom and gloomer. I'm not a end is near kind of guy. But I will get on the show and I'll tell you the truth. We call balls and strikes as we see it, and we'll say, hey, the S&P is really, really frothy. But I'm here to tell you today, we're just not at that point. So yes, there's pockets of AI that are a bubble, no question about it. But the general market, in my opinion, is set to go higher for longer until we get to the point of being radically overvalued. So stay on your plan. Stay with us here. Keep coming back to the show each and every week. We'll see you next week for the live show, episode 200. And then we'll see you again in October for Investor Day. Don't forget to sign up. Katie the Greek has linked those links in the comment section and the description on YouTube, so don't forget to register. Thanks for being with us. We'll see you next time for episode 200.